This meeting is being recorded.
Good afternoon, everyone, and welcome to today's webinar on Canada's Trade Labor Forecast Outlook. I'm Jigar Kanjani, your host for today, and on behalf of Supply Chain Canada West, I want to thank you for being here. You can see everybody joining in. Awesome. While everyone is still joining, we'll begin by sharing a short highlight from our recent Supply Chain Canada National Conference and Golf Tournament that took place in Calgary this past spring, where over 400 supply chain professionals from across Canada came together. Klayton, let's quickly roll the clip.
When 400 plus supply chain professionals from across Canada gathered in Calgary, something extraordinary happened. It all began with the Procurement Professional Open.
In a world where supply chain professionals are required to be so planful and precise, what a wonderful way to kick off the conference by going beyond the boardroom, going beyond the screen, by having fun at the Supply Chain Canada's Procurement Professionals Golf Tournament.
That was a birdie, by the way.
As the sun set over the Rockies, our kickoff reception brought together the voices that move Canada's economy.
This year's theme, Chain Reaction, Powering Supply Chain Innovation, speaks to the accelerating pace of change and the critical role we play in shaping what comes next. Innovation, my friends, doesn't happen in isolation. It's sparked by connection, it's sparked by collaboration, and that's exactly what this conference is all about, and that's what our association is all about.
On the first day of the conference, Premier Danielle Smith delivered powerful insights on supply chain professionals' critical role in Alberta's economic future. Her message was clear: you aren't just managing logistics, you're building Canada's competitive advantage. At the Legacy Award ceremony, we celebrated the giants whose shoulders we stand on. These industry pioneers didn't just build careers, they built the foundation for Canada's supply chain excellence. The 2025 Supply Chain Canada National Conference reminded us that when we come together, we're not just stronger, we're unstoppable. Together, we're building the future of Canadian supply chain excellence. Join us as we continue advancing Canada's supply chain profession.
Thank you for that look back at what an incredible gathering that was in Calgary. The message about building Canada's competitive advantage and supply chain excellence together is exactly what today's session is all about as well. For those who have just tuned in, welcome to today's webinar on Canada's Trade Labor Forecast Outlook. Thank you for joining us. We are just getting started here. Before we jump in, just a few quick housekeeping notes to get you most out of today's session here. Firstly, today's session is being recorded. The recording and the slide deck will be emailed to all the registrations post-webinar, so there is no need to take notes unless you want to. Alberta members will automatically receive 2 CPD credits on your SCC portal. Members from outside of Alberta, please add them manually to your Supply Chain Canada account. Everyone is in listen-only mode to avoid background noise. We have a dedicated Q&A session at the end, so feel free to send your questions anytime using the Q&A button at the bottom of your Zoom window. Now on to the topic today. Here is the reality. Tight labor markets are now one of the top drivers of schedule risk and cost inflation across Canadian supply chains. Projects are competing for the same skilled trades across regions, and many of us have seen the impacts firsthand. That is extended lead times, higher contractor pricing, change order surprises. For 2026 planning to be realistic, we need to move beyond generic assumptions and understand what capacity actually looks like by trade, by region, and by sector. Today's session is about giving you the data and the framework to build those assumptions into your sourcing strategies, contract clauses, and executive dashboards. To guide us through Canada's skilled labor outlook and its implications for supply chain strategy, we have two exceptional leaders joining us today. First, please welcome Klayton, Senior Economist and Head of Business Intelligence at BuildForce Canada. Klayton leads national labor market forecasting for the construction and skilled trade sector, the data that informs capacity planning across our economy. With over 5 years of experience in economic modeling, forecasting, and data strategy, Klayton has unique ability to transform complex labor market data into clear, actionable insights. He holds a master's in economics from the University of Waterloo and has worked with organizations from BlackBerry to school boards, always focused on turning data into smarter decisions. Klayton is also the founder and CEO of Go Analytics, where he helps organizations across sector build business intelligence capabilities and make data-driven workforce and capacity decisions. Klayton will walk us through the national and regional labor supply and demand signals, what they mean for timelines and cost, and how to translate these forecasts into practical sourcing and contracting strategies. We are also pleased to have Allan To, President and CEO of Supply Chain Canada West, joining us today. Allan will share insights on the maintenance contractors landscape outlook and how these labor trends directly impact procurement and operational strategies across Western Canada. Together, they'll both give us a macro labor market view and the practical supply chain implications around it. So without taking any more time, Klayton, the stage is yours.
Yeah, and Clayton, before you start, again, just to encourage everyone to participate in the Q&A, we'll try to keep this somewhat informal as much as possible to encourage the discussion. So do use the Q&A functionality and enter the questions there, and we'll sort of table the questions as they come through. All right, Clayton, back to you.
Klayton, you're on mute.
Is that better now? There we go.
There you go. Much better.
I think when I played the video, it switched me over to mute. But yeah, as I was saying, thanks for having me here today. I'm really excited for today's session. It should be a really good walk through what we're seeing in terms of the trade labor demands at BuildForce Canada. And so in the next 30 minutes or so, I'll be providing a little bit of context here into the current situation within the construction industry across Canada, followed by a 10-year outlook for residential and non-residential construction trade labor demands, as well as taking a look at the supply of labor as that is a key consideration here as well. And bringing it all together to understand what this could mean for the audience here in terms of project costs, timelines, as well as any risks that lie in the forecast. But just before I get started on all of that, I just wanted to introduce BuildForce Canada to those who have not heard of our organization yet. BuildForce Canada was originally set up as the Construction Sector Council almost 25 years ago now. And we are a national industry-led organization committed to providing the construction industry with timely and accurate labor market information, as well as resources that assist with workforce management. So what we do at BuildForce is we produce annual projections of the demand and the supply for construction workers across 34 trades and occupations that we call our on-site trades. So these they account for about 75% of the construction labor force, and these are primarily folks that are out there on the tools day in and day out. We cover all provinces across Canada, and we have in Ontario we have 5 different regions, and in BC we have 2 different regions covering the Lower Mainland as well as Vancouver Island. So our models look at the entire economy, including macroeconomic indicators, demographic data. We look at GDP, all of the investments by industry, as well as we have an inventory of major projects that we use to tune our models. And as an industry-led organization, we do count on a number of strategic partners that work with us on an ongoing basis to validate our forecasting information. So this is really what sets BuildForce apart from other types of forecasters out there, is that we're not just sitting here generating numbers in a silo. We actually go out and test with folks on the ground and ask them if our forecasts are resonating with what they're feeling on construction sites. So before we take a look at the outlook, it is important to understand where we currently are. So I wanted to provide a little bit of context on the construction industry across Canada. So starting here, just to putting it into perspective, the construction industry across Canada is quite a significant industry for the health of Canada's economy. If we take a look at here at the donut chart here, as of 2024, the construction industry contributed to close to $166 billion to Canada's GDP, which accounted for 7.3% of total GDP. So this is quite significant. And in terms of, the industry also has a similar impact in terms of employment, where Canada's construction industry currently employs just over 1.6 million people across the country, accounting for 1 in every 13 workers across the country. So this is quite a far reach from an industry within the country here. And then looking at the composition of firms across Canada, there are nearly 409,000 construction firms in operations. One of the unique points of the construction industry is that it is made up of a lot of very, very tiny businesses. And if we look here, just underneath the donut chart, according to Statistics Canada, about 62% of construction employers actually employed less than 5 people. So that is, something that's quite unique to the construction industry, where you have a lot of players, but a lot of very small players within the contractor and construction firms. In terms of breaking it down by province, while there are just over 1.6 million people working for construction firms across Canada, which is about 25% about 25% of those are working in administrative capacity. So they're working as salespeople, accountants, any other administrative occupation, CEOs, and so on, that aren't on the tools. But this picture here that we're showing now is the employment for those individuals working across the 34 trades and occupations that we track at BuildForce that we deem to be the on-site trades. So as you can see here, it's about 1.2 million people working on construction sites every day. And being that we're talking to the Western folks here, I wanted to also highlight the Western provinces' impact and composition of that employment. So seeing here, you can see that BC, Alberta, and Saskatchewan employ just over 1/3 of all the tradespeople across Canada. So just over 412,000 workers, which is quite significant. So taking a look at labor markets in the construction industry, the question that pops up often is what's been happening recently? And this picture here looks back at the last 24 months. And one thing that's pretty clear from this chart, which has changed somewhat, but not too much over the past even 30, 40 years that we look back, is that construction labor markets are quite cyclical. We can see that by looking at the unemployment rate, which is given here by the yellow dotted line. They do go up quite a bit during the winter months, and they do go down quite a bit during the warmer months when you can be out there at construction sites. And although it's not shown here in this chart, unemployment rates dipped to critically low levels in 2022 and 2023. So I believe it was July in 2022. Overall construction unemployment rates dipped down to 2.4%, which is a level that has never been recorded in the labor force survey before. And those were critically low levels that definitely disrupted labor markets. Now, in 2024 and 2025, we have seen this trend reverse somewhat, where the number of workers joining the construction industry has slightly outpaced the number of new employment opportunities. And it has helped to restore the unemployment rates to some more normal levels. When we look back at the last 5 to 10 years, we're starting to reach some of those average levels of unemployment rate within the construction industry, which are healthy numbers that allow for the flexibility of the workforce that is needed. So at the national level, much of these trends that we are seeing here in terms of rising unemployment rate are driven by declining residential activity, primarily in Ontario, but also British Columbia did see residential activity retreat in 2024 and in the early months of 2025 as well. So for the Western provinces, year to date, we're seeing very significant increases in employment in Alberta that have more than offset, that were more than offset by gains in the labor force. So even though we're seeing very strong gains year to date, the labor force actually has been able to adjust quite quickly. And we are seeing the level of unemployment rate in Alberta increasing a little bit. Now, in BC and Saskatchewan, employment growth has outpaced the labor force growth. So unemployment rates have actually dipped compared to where they were in October of last year. Now, looking at the next important trend here that we can take a look at is the impact that demographics have on the availability of tradespeople across Canada. And this picture here really paints a really interesting picture that shows the progression of Canada's population since 1975. And when we go back to that level, back in 1975, what we see here is that there were significantly more young people and significantly less older people. So in 1975, there were actually nearly 2 individuals under the age of 15 for every person aged 50 to 64. That means that in the 10 years that would follow, replacing retiring workers should be a relatively simple task based on the numbers alone, right? So you have workers that that enter the workforce. There's a larger number of those than there are those retiring from their jobs. So it means that workers would be competing for jobs during that 10-year period that followed, not the other way around where jobs are competing for workers. But if we fast forward, let's say to 2020, what we see here is that only about 16% of the population was aged 0 to 14 years old, compared to 20% that were aged 50 to 64. So as we move into the next 10 years from 2020, so into 2025 through to that 2034 period, the percentage of workers that are potentially retiring is much higher than the percentage of people available to enter the workforce. So this can tighten labor markets just on its own, even if we had flat employment. So if we had no growth or even a slight decline in employment, we could still see labor markets being tight just on the fact that retirements are still a big part of the story here. Now, one of the positives that have come up in the recent years is that the core working age group, so those individuals aged 25 to 49 years old, it has been slightly boosted. And the reason for that has been due to the recent immigration levels that we saw in Canada. But with the drastic cuts that we've seen to immigration, it might not be a lasting trend. So this is something that we're going to have to wait and see. But based on the targets have been adjusted much lower from the federal government. So whether we continue to increase the core working group will depend on those levels of migration. And lastly, I wanted to walk us through the breakdown of major projects that are tracked by BuildForce. So we have a macro system that will generate trend investments and employment, but we tune those trends with the major projects that we consult with our LMI committees, and we research these projects as well as we work with our strategic partners. And what we've seen in recent years was a significant ballooning of major projects. I've been around with BuildForce for about 10 years now, and I've never seen us track this many projects in our major projects. So there's a lot of really large scale projects out there across the country, ranging from resources to industrial building projects, a lot of institutional and government building projects, and so on over the past 5 years that have created this significant bubble here, really, of major projects. Now, this projection and what's driving our forecast is as of November 2024. So some of the projects may have moved around a little bit since we closed this forecast. But based on what we're seeing here is that in 2025, we are at the apex of major project construction across Canada, and we should be seeing some of these key major projects starting to wind down between 2026 and 2030. Now, should some of these nation building projects that have been announced get the green light, should the agreement between the federal government and Alberta lead to more pipeline projects, all of a sudden that decline that we see between 2026 and 2030, if we start to get green lights on all of these projects that we were previously just watching, and now if they become real projects, then all of a sudden that decline in activity there that we see, we might not see that anymore. And we could see that curve flatten out or even see further growth, as some of the projects that are in our watch list right now are quite significant. So with that, we can turn into our forecast for the 2025 to 2034 period. And it's important here to start with our demographic picture, as this has impact not only on the demand for construction labor. So when we have positive population growth, we have additional demands on schools, on hospitals, on shopping malls, and so on. But it also has an impact on the supply, right? So our aging composition has an impact on the supply of workers, as well as any migration that we see into the country will have impacts. So looking at the chart there that shows the population breakdown by age, the picture that I presented earlier is expected to continue over the next decade, where we see the share of workers aged 65 years and older increasing from 19% as of last year up to 21% by 2034. And at the same time, the share of young people, so those 15 to 24-year-olds, is expected to stay steady at 12%. So what that means is that the share of the population that is potentially retiring is expected to increase, while the share of the population that's potentially available to enter the workforce is expected to remain the same. Now, in terms of population growth, we do still anticipate a positive natural rate of population growth for Canada. So we see the number of births still exceeding the number of deaths, although it is getting quite close, which means a lot of our population is dependent on immigration. And as you can see there from the infographic, we are projecting an average or a total of an average of 437,000 net new immigrants into Canada across the 10-year outlook. That number is slightly lower between the 2026 to 2028, given the targets that have been set by the federal government. And if we are to meet all of the demands in our economy, we do project that immigration will have to increase following that period. So across the 10-year outlook, we're averaging about 1.08% in population growth, with slightly lower over the near term. So let's take a look now at what that means for our residential sector. And we're starting here by taking a look at housing starts across the country. And we've broken it out here by different structure types. And in the residential sector, what we've been seeing is there is a significant shift underway that has changed the composition of new housing construction slightly away from single detached homes and more toward apartment structure types. As you can see here, in 2010, the share of apartments was about 34% out of total housing starts. And fast forward to 2024, and we've gone up to 61%. So what does this mean for construction demands? Well, one of the things that we know about construction of apartment buildings versus construction of, let's say, single detached and other low-rise units is that apartments require less labor on a per unit basis. So you could increase the number of apartments, and the increase in labor demands would not be a one-to-one. In fact, you could sometimes actually see slightly lower overall demands for residential labor. And on the flip side of that, single detached and other low-rise units require more labor per unit. So through the 2025 to 2034 period, what we are anticipating here is a reduction in new home construction in 2025, especially in Ontario and British Columbia, which were highly impacted by the changes in immigration and potentially saw some overbuilding of apartment types. In Toronto alone, we know that there have been quite a lot of buildings coming online, and they are sitting vacant as they have not been absorbed by the market yet. We're in Vancouver, we're hearing of similar stories. But while we are anticipating that positive population growth will continue to put upward pressure on the demand for residential construction over the coming decade. Much of this growth that we're seeing is on the low-rise units, especially single detached, which are somewhat offset by the declining construction of apartment units. So what we see between 2026 and 2034 is a relatively stable number of new homes being built. Now, the trends that were described in the previous slide marry up very closely to new housing investment, seen here by the red burgundy line. While we do see a reduction in investment in 2025, based on the reasons I described previously, a recovery is anticipated later next year, which will likely carry new housing investment to growth through to the early 2030s before stabilizing. So despite a relatively stable projection for housing starts, we do see investment projected to see a modest increase after a recovery in 2026. A lot of that being driven by that increase in single detached that we saw in the previous slide. Renovations given by the orange line here, and maintenance given by the yellow line, which also saw a boost during COVID before rebalancing. They are projected to see steady growth across the outlook period as a result of a growing housing stock, as well as an aging housing stock. And as anticipated, tighter labor markets across the entire economy is expected to improve households' disposable incomes. So as labor markets tighten, we are anticipating that wages, there could be an upward pressure on wages, which would translate into improved disposable incomes for households. Renovations are also rising in major urban centers such as Vancouver and Toronto, Calgary, Edmonton, as an alternative to purchasing new and more expensive housing units. So the story on the residential side really is a slight dip in 2025 before a steady growth across several sectors over the 2026 to 2034 period. So looking at what that does to labor demands, we can take a look here at the labor force in 2024 and how that labor force is projected to increase by 2034. So we're expected to see an increase of close to 52,000 workers based on added demands, primarily from the renovation and maintenance side, although there is a slightly positive gain in new housing construction as well. Now, combine that with retirements that are projected at about 136,000 workers, and we have an overall total hiring requirement of just over 187,000 workers on the residential sector alone. Now, these hiring requirements are expected to be offset by just shy of 120,000 workers, but this is an assumption based on construction's share of workers aged 30 years and younger. So this is based on previous trends of how much of that population construction can recruit into the industry. So that number could increase should the construction industry become more attractive relative to other industries, or it could also decline should young people decide that the construction industry is not a place where they want to build a career and they choose instead to go to other industries. But based on all of this, what we see is an overall net mobility of 67,600 workers. So this is a gap of workers that would need to be recruited either from the non-residential side, from other industries across Canada, or through immigration. And that 67,000 that we see there is the combination across the 2025 to 2034 period. But it's really the key there is looking at that as the red bars on that chart that we see there in the change to the residential construction labor force. So what we see there is the intensity of that gap. So anytime that gap is positive, that means there is a gap. If it was negative, that means that there is an oversupply of workers. And what we see here is that in 2025, despite that modest decline that we see, we still have a gap in the residential construction workforce. And as residential markets are expected to recover next year, we see that gap increase quite significantly. So what that would mean for folks in this call here today is that despite a relatively stable level of employment, because of these retirements and because we do have a little bit of growth there, is that labor markets are likely to become even tighter in the residential sector in 2026. As things stabilize, so assuming that we filled that gap in 2026, then that gap does become a little bit smaller in 2027 and through to the remainder of the forecast, but it remains a positive gap. So anytime you have a gap, we are talking about relatively tight labor markets here. Switching over to the non-residential side, and I've broken it down here into two main subsectors of the non-residential side, starting with the construction of industrial, commercial, institutional buildings, and then we'll look at engineering construction in the next slide. So in terms of starting here with the yellow line, which shows our institutional and government buildings, this is where we've seen the most significant growth in the ICI sector in recent years. So there is a significant number of small, medium, and major projects across the country that are currently underway, as well as some that are planned, including major hospitals across most provinces. We're seeing that school projects and the combination of a lot of different schools, post-secondary campuses, correctional facilities. There's work going on at the Parliament Hill in Ottawa, as well as other government building projects. So all of these projects have created a quite significant demand for construction workers over the past few years. And based on what we're currently tracking right now, as well as any proposed provincial budgets, we are still anticipating another 2 to 3 years of fairly strong growth in this sector before we anticipate things to moderate between 2027 and 2028. This activity is, however, expected to remain high even after 2028, given that the anticipated growth in the population will continue to demand more of these institutional and government buildings. On the commercial building side of things, given by the orange line, it was depressed really during the pandemic, where we didn't, we were working from home. The question of whether we needed commercial buildings was under scrutiny, but it has made a strong recovery since, and is expected to continue to rise continuously over the coming decade, in large part given the anticipated gains that we are expecting in the finance and real estate industries, as well as tourism and accommodation and food services. There are some key projects here driving some of this growth, including some key finance towers, renovations work at the Rogers Centre in Toronto, the Atlantic Science Enterprise Centre, Canadian Nuclear Laboratory Centre in Ontario, as well as a Q-scale data park in Quebec. So these are all several hundred $1 million projects. Some of them are $1 billion projects that are driving this outlook going forward.
Hey, Klayton, you and I had a really good conversation yesterday, and maybe if you can relay it back to our audience here around the relationship between residential construction, workforce, and for those in the ICI, and is the workforce fairly mobile between the two, or are they not? And if you can share what we discussed yesterday, that would be helpful to the audience.
Yeah, absolutely. That is something that we hear from the construction industry, that there is mobility, especially between residential, commercial, institutional. We do see quite a lot of mobility there between workers. On the industrial side, however, there tends to be a little bit more of a qualification. So it depends on whether those workers from the residential sector have the tickets that they need to get on that industrial site. But that movement between commercial and residential, anecdotally, we do hear that happen very often. And anybody that drives out on the highway Europe and look at the back of pickup trucks, you're always seeing residential, commercial, institutional fairly frequently. So there is quite a lot of back and forth there. In our models, we treat them as separate. So we have the demands for residential, we have the demands and supply for the ICI sector, but we do know that there is quite a lot of movement in between. So some of those, that gap that we saw in the residential sector, if you see that there is a surplus in the ICI sector, you might see that gap being filled, and vice versa. If you see demands retreating on the residential side, then you might see gaps being filled in the commercial, institutional, and sometimes the industrial sector as well.
Wonderful. Thank you very much, Klayton.
So the last one here to talk about is the industrial building activity, and that tends to be more volatile and respond to activity that's going on in the oil and gas sector, the utilities, as well as transportation and warehousing sectors. So industrial building has been elevated and is projected to reach new highs in 2025 before sort of stabilizing there at these high levels to 2027, and is driven a lot by transportation and warehousing type of projects. There is quite a lot of public transit going on, and there's spin-off activity from that, as well as major liquefied natural gas going on in BC, mining projects as well, and other utilities projects, including some of that sewer, water, and wastewater projects. If there's any type of building structure attached to any of these projects, that would be captured here under the industrial building. But as the tracked major projects that we're tracking here start to wind down, we are expecting a moderation between 2027 and 2030 before growth resumes again later, in line with overall population and economic growth. So some manufacturing projects are also key to some of the growth that we see here over the 2025 to 2028 period. Looking now at engineering construction and starting with heavy industrial activity given by the burgundy red line here. It has seen a recovery since 2020, although we have not gone back to those highs that we saw back in 2013, 2014. And a lot of the recovery that we're seeing right now, although we have seen some recovery in the oil and gas in Alberta, some new projects going ahead. Majority of this growth that we're seeing here has been tied more to the utility sector and including and the LNG sector, as well as some mining projects across the country, including some of that sewer, water, wastewater which we have seen quite a lot of those projects pop up across the country. Looking forward, investment is projected to see a modest dip in 2026, and this is just related to the timing of the projects that we're tracking right now, but it should remain relatively stable throughout the forecast period. Other engineering, given by the orange line here, is another area where we've seen quite significant growth recently, and a lot of that has been related to the construction of major public transit infrastructure in Ontario, Quebec, Alberta, British Columbia. All of these provinces have, we've seen a lot of LRT type projects, subway, rail. A lot of those projects are adding to demands there, as well as some major pipeline projects were recently part of that growth in the recent the last 3 years in Alberta and BC. And so based on the projects that we knew that were moving ahead as of November last year, we are anticipating a retreat between 2028 and 2030 as these projects are projected to wind down. But there is a list of projects on the watch list that, should those projects go ahead, we might not see that dip. Lastly, looking at the construction of roads, highways, and bridges, given by the yellow line there, they have been elevated in recent years based on a number of projects that we were tracking across the country, as well as provincial capital plans. But as those are projected to wind down and complete, we do see that investment level retreating across the entire 2025 to 2034. So flipping over to the non-residential labor markets, what it means here for folks on the call is that competition for workers right now and over the near term is expected to be intense. So if we look at the bar charts there, again, focusing on the red part of the bars there, we do see a quite significant gap in 2025, as well as 2026 and 2027. Now, if the timing of projects move ahead as we were anticipating, we could see things alleviate by 2028, 2029, and in fact, by 2030, we have a surplus of workers. So we have a negative outmobility of workers that could be absorbed either by other industries or by the residential sector as well. Overall, putting it all together across the 10 years, however, we are looking at a positive demand growth of 60,000 workers, added by retirements of 133,000 workers, which puts our overall non-residential sector hiring requirement at 193,000 workers, offset by an anticipated close to 153,000 workers coming in as new entrants from the population aged 30 years and younger, which, if we take a look at the entire 10-year outlook, that means we have a gap of just shy of 41,000 workers in the non-residential sector. Putting it all together for residential and non-residential construction, that discussion of whether we can bring in workers from the non-residential side into the residential or vice versa, it becomes quite difficult because when we put it all together into the total construction industry here, we do see a gap across the entire outlook period. So from 2025 all the way to 2034, we are anticipating that demands for construction labor is expected to exceed our current local supply of workers. So meeting those demands then at the overall construction level means increasing our share of workers aged 30 years and younger by marketing the industry to youth, so that we can start to improve our share of those workers, whether we can also pull from other industries. So there are some goods producing industries where workers have similar skills that can be pulled into construction. So for example, millwrights from manufacturing, they do have similar skills that can be brought into the construction industry, as well as welders, boilermakers. So being able to pull from other industries, that could be an option here as well. And the last and final option for the construction industry here is to recruit individuals from outside of the country to meet these demands.
Klayton, there was a quick question from the audience just around the data here. Does the data for non-residential include all of the recent major projects that were announced by the Carney government?
So it does include some of them, whereas other ones, we're still tuning our forecast. So our new round of forecasts will be available to the industry by June 2026. So we are in the process right now of adjusting our major projects lists. I'm assuming that the question here was about those nation building projects, correct?
Correct. Yeah.
Yeah. So some of them we were already capturing them, and while other ones are going to be added into the outlook. But one thing that I wanted to mention about our major projects is we try not to build a high scenario. We always try to go for projects with a final investment decision, so that we're building a realistic scenario, so that we know that there are a ton of projects that look promising, that could go ahead. But if we don't know their timing, if we don't know their value, and if we don't know if they have a positive final investment decision, then we keep those projects in our watch list. So we're watching those. As soon as those become real projects, that's when we flip them into our scenario. So just to close it off here, in talking about, I think this leads into the next topic, which is kind of the risks, right? So some of the risks here is, all of these nation building projects going ahead, that could be a potential risk here, as well as other risks that we have here is a couple of government initiatives, whether they do go ahead or they don't, it's still up in the air. So they're not part of our forecast that we just presented, but it is something that we have explored in the past. And those two initiatives are the greening of buildings across Canada, as well as restoring housing affordability. So the greening of buildings in our BuildForce Building a Greener Future report, we looked at estimating the labor demands from switching housing units away from fossil fuels and into cold climate air source heat pumps. And we looked at what kind of demands that could generate for the construction industry. We did not look at the non-residential side. So this is strictly only on the residential side. But we estimated that fuel switching would add an additional 16,000 tradespeople across Canada, including HVAC workers, plumbers, electricians. And in addition, we also built into the scenario energy efficiency retrofits that were estimated to make housing units more efficient, such as replacing old windows and doors, re-insulating interiors, exteriors, and attics. And we estimated that these efforts could generate up to close to 41,000 new construction jobs in the residential side. So in total, the residential sector alone could see demands increase by close to 57,000 workers if we are to achieve some of those net zero targets by 2050. And then the second initiative was addressing housing affordability. So CMHC came out with a report that estimated that we would need to build 5.7 million new homes between 2024 and 2030. Our scenario actually extended that to 2033, as 2030 is quite soon. But based on this scenario, we see in the chart here the difference between our housing starts that we have been seeing historical, as well as compared to our forecast, our base forecast, and we see quite a significant increase if we are to meet those housing affordability targets, and that would require the residential workforce to nearly double, and it would also cause the non-residential workforce to increase by close to 50%. So these are initiatives that federal governments have been talking about. Whether they play out or they don't, that's anybody's guess. But if they do play out, the demand on construction would be really significant, and addressing those demands would require creative solutions.
Klayton, just recognizing that we're right at the end of our time here. There's one final question here from the audience, and maybe that's a great segue to BuildForce. We probably don't have time to go through the demo of the product over at BuildForce, but the question was, are there some trades within the construction industry that is more in demand than others? If you can maybe address that question and then maybe speak to and point people towards BuildForce, and there's certainly additional resources there for folks on the phone or on the call today to go and dive deeper into the research.
Absolutely, yeah. I will definitely point you to our website, buildforce.ca, where we publish all of our reports, provincial reports annually, and you're able to access that for free. Each province's report includes an assessment by trade for the residential sector as well as the non-residential sector. So you can take a look at each province, and we actually make it really easy for you, where we have a market assessment tool that ranges from a 1 to a 5. So a 3, a market assessment of 3 would mean normal labor markets. So you might see pockets of tightness, and you might see pockets of loose labor markets. On the shoulder of that, a 2 and a 1 would mean there is an excess supply of workers, where workers are moving to other sectors, other industries. And on the other shoulder of a 3 are a 4 or a 5, which means a 4 would mean that your demands are starting to exceed the local available supply, and a 5 would mean that there's intense scarcity, where you're pulling from other provinces, or you're having to bring in workers from other industries and other countries as well. I wanted to give a little demo. Maybe I can share just very quickly that we also have a business intelligence tool that allows you to actually dive into every single trade. So we give you a macroeconomic look, where you can choose your province and see changes in GDP. We have trading partners, GDP, financial market data, and I understand I'm going very fast here, just being cognizant of the time. But I think what's really interesting here is being able to answer some of those questions on a trade by trade level. So if I flip over here to our construction side, we can take a look at our forecast for employment. So we have first here our breakdown, but we do have our forecast. So I can take a look at the Canada level, or going down to any of the provinces, and see our trade demands on the non-residential versus residential, as well as selecting one of our 34 trades here. So if I select Boilermakers, I can see the demands for Boilermakers in Alberta.
Yeah. Perfect. And Jeff, that sort of answers your question of, yeah, you can go in there and use the tool, and really allows you to take a look at all of that. So we've reached 1 o'clock. So that's the end of our webinar today. I want to thank everyone for your participation. Before you go, I just want to maybe direct you to one additional resource, and we'll include it as part of the post-webinar resources, is the AMCC study discussion paper that Supply Chain Canada recently worked with the Association of Maintenance Contractors, Construction Contractors of Canada, which talks to this short tightening of trade labor, and what can industry, what can stakeholders do to address this tightened labor market. And so I highly, highly encourage you to review and read that. And then most likely we're going to come back and create a whole webinar on that discussion paper as well. Klayton, thank you so much for the fantastic information, market intelligence for our members. I want to thank you all for participating today, and hope to see you at our next webinar or next in-person event. Have a great afternoon, everyone. Bye for now.